ended up with. $33,000 profit on silver, $8,400 loss on gold on a ratio spread. 33 grand profit and 8 grand loss. $25,000 profit. You might be saying, but it's on a 25 spreads. It's still $1,000 a spread. So if I did one spread, I'd still have made $1,000 net. It's not the size of the trade that's important, it's the profit and loss that's important. And we did another spread last night, which I left in again this morning, and it was this one here. As you can see from the markets, it's the Dow Jones 12 contracts short against the NASDAQ 10 contracts long. It's a hedge trade, and yet we've ended up with a double alpha on just 10 spreads of $6,000 per contract with no equity directional risk, which isn't strictly true because we know that these can lead and lag for some time. But at the end of the day, that's why we develop out models, and that's what we were talking about last night. We've been trying the max trigger without stops, interestingly enough. So obviously we had a few problems last night because Stu Bob is now in isolation for COVID. So Stu Bob wasn't able to attend last night, but he did come in live from his office, and he was able to. We were talking about Max, and what he was doing was he was taking live trades against the Max signal, but in a hedge trade setting. He was simultaneously buying the signal and selling the opposite in terms of indexes. So it's an S&P NASDAQ trade. And it just, without any stops, in other words, we were using Max to flip the book. No stops whatsoever, because it's in a hedge. And it was up, for that day, it was up over $1,000 on a single contract. On a hedge trade. $1,000 single contract using the Max triggers. So these are the types of ideas which we can obviously develop and run with. Obviously, I was talking to Kim last night as well about the margin requirements for spread traders. Perhaps there's a requirement to double up on spreads on margin. I hope it's not the case. I hope it's not the case. And but if it is the case, obviously it means that it's going to be limited to slightly bigger accounts because obviously we've got double margin for the same size of trade. John, well, obviously Max has got its own background, hasn't it? So when the Max trade is setting up, it's triggering basically a rubber band type trade process. So you know, on that basis, that when the trade's setting up, it already has that triggering process built into it when it triggers. So it's taking away the need to have a stop on Max. It's taking a spread instead of a stop. And when that comes into the trade, without coming up with any other rules, it's then looking for the opposite to close out the deal. It's looking for the opposite signal to close out the deal, which is which may prove to be a very, very nice way to take forward the project. Because if it does $1,000 a day, of course, well, it'd be fantastic on a one lot, wouldn't it? It'd be fantastic on a one lot. Wouldn't it be more profitable? Well, the thing is, Jack, yes and no, and I'll qualify that, obviously. Yes, it could be more profitable, but that depends upon the management rules that you set up for Max. Because the spread trade is now an open-ended spread, it could pick up some incredible profits because you don't need to put a management rule in place. Do you know what I'm saying? If we go in for an outright trade, say for example, we set an outright trade and we say, right, simply, we're going to go for 4 ticks profit and 4 ticks loss. Well, you can only ever make 4 ticks on a deal. If we go in for 10 ticks profit and a 10 tick loss, we can only make 10 ticks on the deal. So whatever the management rule is, we can only ever make what we can make on the deal. But because max is getting managed in the spread as a spread, it doesn't need to have a set rule to close out the trade. Close out the trade. As a result, the trade stays in place potentially for quite a sizable move, potentially making a significantly bigger profit on that deal. So there are occasions where the answer is going to be absolutely, and there's going to be occasions where the answer is no. It actually helps the trade make more money than it would otherwise. So I don't think there is actually an answer to it. It depends upon the rule set. And we're not saying for 1 second that that's what the max program is going to be, but that's what one of the max programs can be. And it's up to the individuals to watch and evaluate each of the max programs that are trading to decide which ones they would like to participate in. So there's going to be outrights and there's going to be hedge spread type trades. Do you know what I mean? So it's not going to be an either or. It's going to be a choice that people can make. They may decide that they want to do this program because it fits their risk parameters better, or they might prefer that that program might be a better fit for their risk parameters or their account size. In which case, of course, that's going to be perfectly fine. That's the trade that's going to be set up for them inside the management facility.